Morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another one of these Monday market updates coming to you at 9 a.m. Monday mornings. I've got a great topic for you this week. Even with the 15% rebound in stocks, it looks like today we're going to open quite a bit lower, but there are still some great deals out there to be had, especially in the commodity space and in dividends. So I want to get to that. Stick around though, because after that we'll have our Monday market update, giving you all the stocks you need to watch this week, the economic news that comes out that could affect stocks, and as well as answer your questions. So I want to get right to it because a chart in Bloomberg caught my eye last week. You know I'm a sucker for that cash flow and dividends, and this chart showed the 12 highest paying sectors and industries within the stock market. So drum roll, coal miners came out on top there, which is a huge turnaround. But I want to talk through some of these sectors, some of these industries, and then talk about the 7 stocks that I'm watching with some of the highest dividends in that commodity super cycle space. Okay, we're going to talk about the commodity super cycle, what it means, why we're so bullish on commodities and some of these other minerals and metals here, and all that good stuff. Now, so as noted in the article, it is a really surprising turnaround for coal, right? Coal coming out on top here to 6% average dividends for the companies in that industry, for an industry that was just on the verge of bankruptcy not more than a decade ago, right? In fact, I lost a bundle when the largest miner, Peabody Energy, did file bankruptcy. That was back in, I believe, 2014 when they ended up filing bankruptcy. And it's why I always warn investors to dollar cost average with extreme caution. Never put more than 5 or 10% of your money in a single stock. So, we all love to dollar cost average down when our stocks are falling and try to get there on the rebound. But if you continue to do that, you continue to buy more and more stock of that same company all the way down, then sometimes you get what we had there in Peabody Energy. You get what we have in stocks like AT&T, stocks like GE, General Electric, stocks like BlackBerry, Research in Motion there, that will never get to those peaks once again. So basically, even if the company doesn't file bankruptcy, you have just lost a ton of money because you are 20 or 30% of your money in just one stock. So I always caution against that dollar cost averaging to the extreme there, 5 to 10% at most of your money in a single stock. But anyway, this is a huge turnaround for coal. And it's a lot of it really speaks to a lot of the problems we're having in commodities right now. The 2014 sell-off in oil, the 2010, 2011 sell-off in coal. The past decade has seen massive sell-offs in a lot of those commodities, right? We had that huge super cycle there in the early 2000s for a lot of these materials, especially energy products, coal, oil, things like that, and then just a complete destruction of the price there. And so what happened is underinvestment in new coal mines, new oil fields, a lot of those metals, copper especially. There was just underinvestment for almost a decade in new production, right? It takes years. It takes almost a decade to explore and develop a new oil field. Same thing with coal, right? And a lot of these commodity producers, they're seeing that demand destruction later on in the future, and they're not going to be spending the billions of dollars or the millions of dollars that it costs to produce new fields, right? So that underinvestment over the last decade, because those prices were so low, because the prices were under the cost of production, then we are now in a supply shortage for many of these commodities. Just when we could be likely to see a commodity super cycle, another super cycle like we saw before 2010, where the prices of a lot of these commodities just take off. So what you get here, and in fact, that's the opinion of Goldman Sachs. Goldman Sachs has been saying for the last couple of years, we're heading into a commodity super cycle where these prices of these commodities will jump again. They're talking about $110, $120, $140 per barrel of oil next year. They're talking about coal. They're talking about natural gas, as well as copper, and a lot of these other coppers that we have, or a lot of these other commodities that we have talked about on the channel. So I want to go through these. Go through some of these sectors. So we have coal mining there on top with 6% average annual dividend for those companies. Real estate's kind of interesting here because I think you all know that I love real estate. Started my professional career in real estate as a commercial property analyst. But the real estate dividend here I think is misleading because we have seen such a fall in some of those real estate stocks, some of those REIT stocks this year. Prices down 20-30% on those stocks. And of course, the dividend hasn't come down. They haven't cut their dividends. So that dividend yield is subsequently even higher than it has been in the past. I still like real estate. I still like some of those, some of those REIT stocks. We've talked about MPW, Medical Properties West. We've talked about STAG, ticker STAG. We've talked about, of course, all you out there, a lot of people, a lot of investors out there love that realty income for that monthly dividend yield. A lot of those real estate stocks are good investments, good long-term investments, and great yields right now after those stocks have come down. Energy stocks paying out a 4% yield on average. Of course, those stocks have just went through the roof this year. So far, the energy sector in the S&P 500 is the only sector out of all 11 sectors that is in positive territory for this year. And in fact, those stocks are up about 65% on average this year. So energy stocks, not only are you getting a strong dividend yield there, you're getting a very good price return. Financials, we've talked about financials quite a bit on the channel. I love the financials for later on into 2023. If, as soon as we get through that recession, financials, those yield sensitive stocks are always the ones to rebound fastest. And financials have really been taking it hard on those those worries about a default, but they have those higher interest rates that they're making a lot more money on. But I want to back up here. I want to talk about these commodity plays like coal miners, like energy stocks, like some of these other these mining stocks, because as I said, there has just been a massive underinvestment over the past decade in these exploration and developing of these commodity resources, right? We are looking at a massive copper deficit by even as early as 2025. We're looking at, like I said, Goldman Sachs is projecting for oil to be at $120 to $140 a barrel in 2023. Coal miners are doing so well that they're paying out the highest dividends of any other U.S. industry. And it's because, again, of course, we have no supply of these. We still have strong demand. And these companies, they're seeing the writing on the wall over the next few years, right? Especially coal, especially oil companies. They're seeing that demand destruction into the future as we replace those fuels with alternative energies. So they're not going to be, even with prices this high, they're not going to be investing in new fields, in new exploration. Instead, they're returning that cash to shareholders, and it's becoming just a massive cash bonanza for shareholders through these dividends as well as through share buybacks. So I want to look at 7 stocks in these names. I want to look at coal. I want to look at energy, so oil stocks, and I want to look at copper, because we've talked about copper on the channel. Not necessarily quite the same thing as we've seen in oil and coal here. Copper, they did have a massive underinvestment over the past decade as well, but it's not something that these companies aren't looking out in the future and seeing demand destruction. In fact, they're seeing a huge demand surge into the future as we replace a lot of those fossil fuel electric powered stuff with alternatives like solar power and things like that. The thing with copper is it is used in everything right now, and it is about to see that demand surge from those alternative energy sources, because anything that runs on electricity has to have copper in it. Copper is a great conductor of electricity, so you get 3 times as much copper used in an electric vehicle as you'd have with a combustion engine. You have to have that copper in pretty much anything that has an electric current through it, and of course, with alternative energy, with the electrification of the world over the next decade to get us off those fossil fuels, that is going to just be a surge in demand for copper, and we just don't have the supply for it. We don't have the investment in new mines and production. Now, there is recently really interesting news coming out that one company. And I can show you this later, but one company has actually found a way to get more, get more of copper out of the ore dug up in copper mines. In the past, there has been a portion of copper mines that ore has not been, the copper in that ore has not been accessible, right? So it's been gone into waste fields. In fact, this company says it could potentially unlock something like, I think it was like 4 trillion tons 4 trillion metric tons of copper out of these waste fields that was dug up out of copper mines in the past and just hasn't been used, hasn't been processed because it was so expensive to dig it to process it out of this specific type of ore, right? So if that is being tested by a lot of copper companies, by BHP, by FCX, by some of these other copper companies, SCCO, to see if that process can be done in a cost-effective basis and can kind of relieve this supply-demand problem that we have coming up in copper. Because as we've talked here on the channel over the past couple of months, if that does not work, if that process does not unlock all these copper reserves that haven't been processed, then we are heading for a massive copper shortage as early as 2025. As we start needing that copper for all this electrification, copper prices could surge. Actually, Goldman Sachs was predicting copper prices of up to $7.50 a pound or more. Right now, it is at about. Right now, I think it's about 350, 450, something like that. So it would be basically doubling of copper prices here over the next 2 years if we don't get some kind of additional supply online. So we have been looking at copper. A lot of these copper companies, paying out very good dividends, even if that process is able to go through, and we do get that surge in copper. Copper prices might not go up quite as much, but of course these miners are going to be able to process so much more copper and sell so much more copper. So I think the miners will do very well even in that situation. So basically, it's a win-win situation for copper miners over the next few years as they either get very much higher prices for their copper or they sell much more copper from that new process. So I want to look at some of these stocks that I looked at, that I researched for this idea. We've got in the coal space, we've got Alliance Resource Partners, ticker ARLP. That's going to pay a 6.6% yield. That's followed closely by Natural Resource Partners, ticker NRP, with a 6.2% yield. And again, these coal miners, they're fairly small, less than $1 billion market cap on these companies. But they are paying just amazing dividends right now, and they're safe. They're stable dividends as of right now. And again, I'd be hesitant to say that these are long-term plays in these coal miners because obviously, just as we saw there in 2012, 2014, when coal just evaporated, when the price just got destroyed, and a lot of these companies went bankrupt or were very close to bankrupt. So right now coal is paying the highest dividend yield of any industry in the S&P 500 in the market right there. But this is probably maybe a 1 or 2 years longer out there, like we were talking about with copper. Southern Copper, ticker SCCO, paying us 5.9% yield, and again, I think it's just a win-win situation for these copper miners, right? Because they're either going to, excuse me, they're either going to see the price of copper double over the next couple of years, or they're just going to be able to sell so much more of it. They're going to be able to double their resources that they're selling to be able to make more money and greater cash flow. So I'm very much bullish on the copper miners over the next couple of years, and that's a really good long-term play. Within oil and gas, we've got USAC, ticker USAC, USA Compression Partners. They do natural gas compression. Very good resource play there in natural gas, and pays an amazing 11.3% yield. So very high yield there. That's one we highlight on the channel quite a bit. Pioneer Natural Resources, ticker PXD. This one is going to pay an 8.1% yield. Very strong oil explorer. And then two that we've talked about all the time on the channel. All you out there in the Bowtie Nation are going to recognize these. This Devon Energy Corporation, ticker DVN. We've held this stock for a long time and have benefited from a huge run up just over the past year. You can see this chart. $42 there over the last year, up to $68 now. That's about a 50% return, even in the past 5 years. you see off of this off of the pandemic lows when oil really bottomed out right around $10 here. It was $6 a barrel or $6 a share, now up to 68. So you got about a 12 times return on your money in Devon Energy, along with that very strong dividend yield. At one point this dividend yield was upwards of 8-10%. Right now it's about 6.8%. Now Devon management did say in its last earnings report that they were going to slow down their the pace of dividend growth. They have just tripled, quadrupled dividends over the past couple of years because of that cash flow. They are now going to slow down the dividend growth. They're going to put a little bit more towards exploration, towards production. With prices this high, they can't see not producing a little bit more, but they are going to continue to be a great dividend play, as well as a strong play on those oil prices. So I really like Devon here. Continue to like that and continue to hold that share stock. Diamondback Energy, ticker FANG, another one that we've held quite a while here on the channel. Diamondback Energy has a 5.9% yield. A lot of the same things we talk about with Devon Energy. They've both got a lot of resources there in the Permian Basin there in Texas, one of the lower cost producers in the market. The Permian Basin is quite a bit lower cost to produce oil out of than some of your Bakken and your other shale resources. So Diamondback does well. Devon Energy does well. Some of the lower dividend stocks there in the oil space that I like, Chevron. I hold shares of Chevron. We hold shares of Conoco Phillips there in the Bowtie Index. So a little bit lower dividend on those, but very strong price appreciation on those as well. And we could talk more about those in the rest of the chat. I want to turn it over into the market update here this week, what I'm watching for this week, some of the stocks I'm watching, as well as the economic news that could kind of move markets and move stocks. We do look like we're heading towards a lower opening, 0.8% lower on the S&P futures. A lot of that has to do with the unrest there in China and just the fear that the China might not be reopening as we had expected, and kind of lifting that the global market. So I want to look at some of these stocks that are going to be reporting this week. Earnings all but over for most of the market, but we still do have some stocks reporting this week, as well as some very important economic news. First here is Crowdstrike Holdings, ticker CRWD. It is expected to report on Tuesday, tomorrow. Expected to report an 82% earnings growth over the last year, 31 cents a share on 51% sales growth to a little over $500 million. Just amazing growth here in the cybersecurity companies we've seen. That's probably the only growth stock or the only growth theme that hasn't slowed down this year. It's continued to survive and grow this year. Crowdstrike full year sales are expected up 47% to $2.2 billion. Now, even on a 20% drop, though, the share price is still trades at 15 times on that price to sales basis. So, a little bit torn here with cybersecurity companies, even CrowdStrike here, which is a good one. They're still well over my 10 times price to sales limit for growth stocks. It saved me a ton of money when all those pandemic growth stocks were just trading at ridiculous valuations, right? Before February of last year, and before that, when all these hot stocks were trading at 20, 30, and 40 times on a price to sales basis, I just couldn't buy at those ridiculous prices, and it saved a lot of money because those stocks have come down 80-90% now. I still can't see it. I still cannot see paying more than 10 times on a price to sales basis for a stock, even a growth stock growing at 20 or 30%. CrowdStrike growing at 47% a year. It's tempting, but I'm still just too cautious to pay too much for a stock. Next stock here is Salesforce. All you out there in the nation know this is one of my favorite companies, one of my long-term, forever stocks. Salesforce, ticker CRM, just leads in so many of the long-term themes of those big trend universal forces that are changing our world. Things like AI, things like automation, things like the blockchain. A lot of those technologies just leading in that space. reporting earnings on Wednesday. Should have no trouble beating those expectations of $1.22 per share. That is actually a decline of 4% from last year on 13% sales growth. So a lot of what we've been seeing in the market with this earnings season is companies still reporting very good sales growth, upwards of 9, 10, 15% sales growth, but then earnings decline. And of course, what this is, a lot of this is just that inflation is pushing prices up for these products, but they're not able to push all those price increases through to consumers. So they're having to eat some of that inflation, and that's as far as wages going up, as far as their own supply and materials going up, then that is eating into their profits. So a 13% sales growth here, 4% decline in earnings. I think they'll come out positive, so maybe flat earnings over the year, probably $1.30 or so per share. So they will beat expectations. Of course, it's all on what they say for the rest of the year and for into 2023 is what's going to be important for the stock. Full year sales are expected up 17% to $31 billion, which makes about a 46% slide in the stock this year. Seem a little bit overdone, right? The shares are down 46%, shares of Salesforce down 46% so far this year, and the company is still growing at 17%, sales pace a year. So that's shares now trading for 5 times sales. I own the stock. It's not super cheap, but it's still very attractive for a growth stock like Salesforce. This quarter, I do expect sales for the Tableau and the MuleSoft applications, 2 applications that they're running to be really the bright spot for the quarter. And again, the company is leading in a lot of those long-term growth themes that you want to be watching. Next stock here, Ulta Beauty. Ulta Beauty is going to report, I believe, on Wednesday or Thursday. Let me see here. It's really bucked the trend, though, in consumer discretionary, right? This stock is actually up 7% on the year. So what we've been talking about a lot is kind of that lipstick index, right? A lot of these beauty companies have been able to beat fears of a recession, because the idea is that it doesn't cost too much to buy some lipstick, and that as people start cutting back, then they're still they still want to look good, and they still want to they're able to spend a little bit on some of these smaller discretionary items, even if they pull back on maybe cars or some other things. So again, Ulta Beauty up 7% this year. Beauty product companies are going to report on Thursday. Expectations are increase earnings to 4.8% over the last year to $4.13 a share. That's on 10% sales growth. So again, we're seeing higher sales growth than we are earnings here. So again, they are they're able to raise their prices for inflation. But then not able to pass on all those costs to consumers. So lower sales or lower earnings growth, that 4.8% earnings growth versus 10% sales growth. It is following very good results from peers like L'Oreal and Coty, which both reported sales up 9% for the quarter. So I think that 10% sales growth expected for Ulta is probably right on track. Now, Ulta does seem to surprise a little bit more, on the sales and on earnings numbers than some of these other companies. So it could go a little bit higher than that 10% expected, but I think that's right on where it probably will. Sales in China have been slowing down for these companies, but sales in the U.S. are still very strong. Management has a great history of beating those expectations, but they do look a little stretched at this point. Against that larger economic backdrop, I'd be cautious here on earnings. If you do buy in, I'd buy in with maybe no more than half of what you were going to, and then use the other half to maybe pick up shares on a pullback, because they are, as I said, they are up 7% this year against a market that's down 15%. So outperforming the market pretty handily this year, and maybe a little bit expensive at this point. Next stock here, I'm watching Zscaler, ticker ZS. It's going to report its earnings on Thursday. Another one that we've been watching on the channel for a long time. Actually recommended shares of Zscaler back in 2019. You see back here, way back in 2019, I think it was October 2019, they were at $42 a share. Made it all the way up to looks like $350. I didn't have the guts to hold on to them that long. Okay, had them about $50 a share back there in 2019. Ended up selling right around $200 a share. So Missed out on some of that upside there, but I'll take a 4 times return on my money any day of the week. And we did sell when it started looking a little bit expensive there, and now they're back down to $138 a share. Now, what you got to understand about Zscaler, it is one of those cloud-based security companies, so cybersecurity, so it is doing very well. Expected to report 85% increase year over year on its earnings to 26 cents a share, 49% sales growth for the quarter on a year over year basis. So again, those cybersecurity companies just growing like none other. I think as enterprises, as a lot of other businesses kind of pull back on their IT spending, pull back on their marketing, pull back on a lot of those other costs, that other spending that they're doing ahead of a recession, they are still spending more for their cybersecurity because they know how damaging some kind of a hack can be to their companies. So they're still spending for cybersecurity. Zscaler, one of the best because it is that cloud-based security idea. One of the things we pointed out there in 2019 when we were buying shares are down 51% from the peak, though. So still trading for 13 times that expected full year sales. So again, this one is still over my 10 times price to sales limit. 1.5 billion in sales expected. I reckon, if I was going to break my rule though for 10 times price to sales, I think I would do it on this company, Zscaler. Again, 13 times price to sales for full year expected sales of 1.5 billion. But any company growing sales at 50% a year, as well as has that competitive advantage against a lot of its peers in that cybersecurity space, which itself is just growing double digits a year, then I think this stock is one that can grow into that sales, into that valuation multiple, and can still do well for you, even if the shares come down just a little bit more from these levels. Want to look at the sectors, what the overall bigger picture is doing here, give you some kind of ideas on what to invest this week. And so here we are on the sectorspider.com, the sector tracker, one of my favorite tools there, sector tracker. You can pick any of these ranges here, these periods, and find what stocks did. We'll go to the 5-day period, see what stocks did last week. All 11 stocks did close higher last week, with something really weird actually happening at this sector level. This is something that you miss if you just kind of watch the individual stocks and things. So you really do need to look at the market at this sector level, because rather than the riskiest sectors like technology, consumer discretionary, communication services, so you've got those, the XLC, communication services up 1.3%. You've got discretionary, consumer discretionary up 1.16%. You've got technology up 1.14%. When the market rebounds and investors head to these to those riskier sectors, those riskier stocks, because those do tend to do better in a rebound. Rather than that happening last week, though, we saw the strongest gains in traditional safety sectors like consumer staples was up 2.1%. You saw healthcare up 1.9% last week, and utilities was the best performer last week at up 3.4 or 3.04%, right? So the utility stocks in the utility sector doubling what the stock market did last week. Stock market up 1.5% last week, and I think a lot of it wasn't necessarily a snapback from valuation on recent losses, because all three of those traditional safety sectors, the healthcare, utilities, and consumer staples, have done well. As the stock market increased and a lot of investors rushed to those high risk, high growth sectors. But it was really kind of a lower interest rate play, right? Lower interest rates do generally help these three dividend yielding sectors, right? As interest rates go up, these three sectors that consumer staples, healthcare, and utilities, they pay very good dividend yields. Investors invest in those sectors for the dividends, and as interest rates go up, then investors tend to kind of get pulled out of those sectors, out of those stocks, because they can get higher interest rates in safer investments like bonds and other things. But rates really didn't come up that much or come up that much last week. So, best guess, it was really just the odds of a recession are just creeping up, and institutional investors are switching their portfolio into that safety mode. So this is something that I think we could continue to see here over the rest of the year as institutional investors, as the community, the stock market community kind of looks to a recession in 2023, kind of tries to protect themselves a little bit more with these safety stocks and buying more of these three sectors into the year. on a price to earnings basis, the three least expensive sectors according to FactSet. In here instead, I'll just open up FactSet and we'll look at the that. Again, FactSet Earnings Insight, one of my favorite tools. Here you can download this for free. We'll open up the downloaded one so we can see it a little bit better. And here we go. Now this is going to show you a lot of sector and market expectations kind of ideas. We'll just fast forward down here to this S&P sector level forward 12-month PE ratio chart, right? So this is a chart of the of all 11 sectors plus the market, the S&P 500 index there. You're seeing the dark blue here is the forward PE ratios, right? So the price of the stocks in each sector divided by the earnings expected over the next 12 months, right? So the PE ratio for each sector. The green here is the 10-year average, so a long-term average. So it's a great chart to see, according to, relative to history, which stocks in which sectors are cheaper and which are more expensive, right? And for the most part, we do see stocks still rather expensive on a valuation basis compared to history. We're going to see most of the blue lines here, the current PE ratios on these sectors, higher than those green lines, even though they are down from the middle line, which is the 5-year average, right? So you've got on the left here, you've got some sectors like consumer discretionary trading at 23 times on a PE basis versus 22 times long term. You've got information technology, so tech stocks 21 times on a PE basis versus 18.6 long term. So quite a bit more expensive there than their historical averages. On the right here, you've got some of the least expensive stocks, expensive sectors, and these are the ones that we want to focus on, right? If you're that value investor, if you want to get the best deal in the market right now, you're looking at energy, which is trading at 10 times forward PE versus 15 times long-term average. So energy stocks, even though energy is up like 65% so far this year, a lot of those companies still trading for attractive valuations on a PE basis. Financials, again, financials are one of the best sectors that I'm looking at, especially into 2023, trading at 12.5 times PE ratio right now versus 13 times that long-term average. So trading under that long-term average, as well as producing a pretty good dividend yield on those stocks. Communication services. This is the interesting one here. Communication services. So within that communication services sector, you've got internet names, you've got telecom. We can always go back here to the sector tracker. If you go to communication services or any of these, click on that, and you're going to see all the companies in there in that index. And of course, what we see over the year to date so far, communication services down 35%. It's the hardest hit sector so far in this session, in this bear market, with a lot of these stocks, down very much. That didn't. See if this will. Here we go. Okay. You can see here a lot of those streaming stocks, which includes Disney, which includes Warner Brothers, Netflix. You got the internet names, the social media stocks like Meta Platforms. You've got entertainment stocks like Live Nation, game stocks like Take-Two Interactive, as well as the telecom carriers, right? You've got Verizon in there, you've got AT&T. So communication services are really a kind of a jumble of a lot of different industries, unrelated industries. You've got internet, streamers, telecom, and entertainment, things like that. But it was really interesting that if we look here at the valuations, communication services is actually trading below its long-term valuation. Okay, we see here that dark blue line here, stocks in the sector trading for 14.9 times on a price to earnings basis versus 15.8 times that long-term average, right? And what we normally see here with these stocks in this communication services sector is these are a lot of growth stocks with very high valuations, right? These social media stocks, the streaming stocks, the entertainment stocks, a lot of these generally have very high price to earnings ratios of 20, 25 times on a price to earnings basis, but have been hit so hard this year. Meta Platforms, Warner Brothers, Disney, even Netflix, that they are now in value territory, right? So I think it's a great opportunity. There still could be some more pain to come. I am expecting the market to give back some of this recent rally into December and January, but eventually this recession is going to be over, folks. Eventually, companies are going to continue to spend more on their marketing budgets. The economy is going to grow again. And that's what's really been hurting a lot of these stocks, especially the streaming companies, especially the social media stocks, the gaming stocks. Those are going to rebound. And generally, I mean, you look for the hardest hit to see the best rebound. And I think this is where you're going to find it in this communication services. So a lot of good deals to be had there. This week, a lot of news coming out this week. We do actually see the second estimate for GDP for the economy growing this week. It's expected to the economy to have grown 2.7% in the third quarter against initial estimates about 2.6%. So basically about the same. The real news is going to be those estimates for Black Friday and Cyber Monday sales. We are already seeing some data. Adobe Analytics is hooked up to like 85% of the largest 100 e-commerce sites. So they already gave us an idea that shoppers spent 3% more online on Thanksgiving Day this year. Though I think, a lot of people are talking about the 9% increase in retail sales over Black Friday over that week versus last year being reported. This 3% more spent online on Thanksgiving Day. A lot of people are looking at that as some kind of an optimism as far as consumer spending, but I think a lot of that is just going to be inflation, right? A lot of these companies, they raised their prices, over the last year for inflation. So I think a lot of this 3% increase on online spending, the 9% retail sales increase that we're hearing about, a lot of that is just going to be inflation, right? And so I don't think it's going to really add to the earnings of a lot of those retail companies, over the last year. Just anecdotal evidence that we've heard from companies like NPD, Retail Industry Group, NPD, a lot of channel checks by analysts. A lot of analysts, basically, they will pay people to stand outside stores, specific times each month or during Black Friday to see how long the lines are, how many people enter the stores, just to give them kind of a qualitative idea of growth for that company and for the market. In the channel checks, the other anecdotal evidence that we have, and probably your own personal evidence, if you went out, Black Friday or Thanksgiving to shop, is that lines were much shorter this year. It was not a problem finding some of those deals in the stores. It was not a problem getting around in those stores, and I think that's going to be a bad precursor to these Q4 earnings when they do come out in January and February. We're also going to see Thursday an inflation. Thursday, December 1st, the PCE index, the Personal Consumptions Index on inflation comes out. That is the Fed's preferred measure of inflation, how really they watch inflation, whether it's growing. Expectations are for the headline number to come in down a little bit, just to 5% from 5.1% last month. So if that comes down quite a bit more, like we did see in the PPI and the CPI numbers, that could help spur the market a little bit. But I don't see inflation falling too fast here, over the next couple of months. We're also going to get that jobs report on Friday. It's expected the U.S. added 200,000 jobs in the last month. That would be down from the surprisingly high 261,000 jobs reported last month. So last month was expected that same 200,000 level, ended up being 261,000, 200,000 expected for this last month for a report on Friday. That could be above expectations as well. And of course, last month that was a negative for the market because it does show that the Fed might still have to increase interest rates a little bit faster or a little bit longer to bring jobs down a little bit and to bring inflation down a little bit as well. Now I want to kick it over to question and answer. I'm going to scroll through here and see what questions we get. I see a lot of you out there in the Bowtie Nation, a lot of citizens out there. Ambrose, good to see you there. Michael, Melanie, always good to see you. Ambassadors, they're from the Bowtie Nation. Melanie, they're from Seattle. We got from Texas. We got I saw one from Switzerland. That's awesome. But I want to scroll through here and see what we got as far as As far as questions, Vivek, thoughts on SaaS companies, so software as a service companies like Twilio and Mongo. I haven't looked at those stocks in so long. I really can't give you an idea or an opinion on those. Those software as a service companies. Those were some of the strongest during the pandemic. Really saw huge huge returns in the pandemic and have crashed down lower. But really, basically, when you're looking at these stocks, these growth stocks or these one-time growth stocks, you really got to look at the company, not the stock price. Okay, you've got to look at the company. Is it still producing a product that is changing the world in which we live? Okay, is it still is that industry still growing and growing? Changing the world in which we live. Because if it's still doing that, it's still a growth company. And as soon as the market comes back to these growth stocks, right? As soon as investors come back to these growth stocks, then those prices are going to go much higher. Okay, so a lot of these companies that I'm investing in. Teladoc. Teladoc is one of my favorite examples. SoFi Technologies, okay, ticker SOFI. Teladoc, their ticker TDOC. The stock prices have come down, horribly, right? I think Teladoc is down something like 85, 90% from its peak. I started buying in January of this year, and I'm even down like 30% from just January, right? It's continued to fall this year. SoFi Technologies down, I think something like maybe 75% from its peak as well. Again, there I started buying in January and February, down about 25% down so far on my cost basis. And so you look at these stocks and they're down, down so much. But you look at the companies, you look at that sales growth, you look at the expected sales growth over the next few years and what their product is doing for, in our lives. And they are still growth companies. Okay. So, if you've got a time horizon of more than 3 to 5 years, then these are still the stocks to be in. Okay. It may take a very long time for them to hit those previous highs. Those were just ridiculous valuations and never should have been that high. But they are, from here on and for this year and from this year on, they are still good stock, good investments, over that long term. Pump those numbers. Favorite semiconductor stock. So Gabrielle wants to know favorite semiconductor stock. Semiconductors, they're heading through a very tough period, right? So I don't know that I would be buying semiconductors just yet. Two things holding those back, or a couple of things actually. Semiconductors, you got to understand about semiconductors, it is very cyclical. They go from being, supply shortages to supply, just massive supply overnight, right? So it is even more cyclical than some of the miners and some of those other industries where we'll be in a shortage so companies will go into a new growth phase. We'll start just churning out those chips, and then we're into a supply, too much supply. And I think that's what we're seeing right now. Okay, over the last few years, we have been in a semiconductor shortage. The manufacturers and the fabricators, they just pumped up their supply, and now we have too much. We have too many chips. So it is a big turn. We are seeing a much lower PC demand this year and probably next year as well. So personal computers, during the pandemic, everybody rushed out to buy new computers because they thought they were going to be working from home. So, you don't need to buy a new computer maybe every 3 years or so. Right, so we're seeing a very big drop off in PC demand. We're seeing a big drop off in the semiconductor chips for gaming units, for mining, for cryptocurrency mining. That has taken a huge hit, the chip demand for that. So a lot of these semiconductor companies seeing much lower demand for their chips, and they're still oversupplied in their manufacturing, in their fabrication. So I'd be worried about semiconductors at least into next year. I think you can head into it next year. I tend to stick with the larger companies with this one. You got Texas Instruments, you've got Intel. Intel is the story that's always supposed to rebound the next year, always supposed to get its mojo back, and never does. But I think Intel is a very good value play at this point. You've got TSMC, which is kind of a tricky one because it is by far the dominant player in chips, but you always kind of have to worry about those geopolitical risks with that stock. What else? So yeah, Andrew S. Points out Texas Instrument as a chip maker, strong tech chip maker, and I would be looking at some of those chip makers. AMT or AMAT, Applied Materials, is also a good one. Those U.S. based ones, as this chip wars, as the semiconductor wars heats up between the U.S. and China, the U.S. is going to be pushing a lot of money and a lot of favors to its own domestic chip makers. So I would be looking at those. Thoughts on, Connor's thoughts on buying futures contracts on orange juice. I hadn't seen any kind of news on orange juice, whether, orange juice prices should be going up. Now, we did have a huge cold snap over the past week here in Florida, which obviously is the orange juice state, right? So, there might be something there. I would expect that to be built into the prices, though, as futures traders are usually pretty good at kind of predicting supply shortages and things like that. So I don't know. I haven't looked at orange juice futures. I am trading oil futures right now. I am looking at natural gas, copper, as well as shorting futures on the S&P 500 as a hedge against the rest of my stocks. Just in case the market falls further, I'll make money on those those shorted futures contracts on the market, and kind of offset some of that loss in my stocks in my portfolio. But copper, I'm watching copper futures, oil futures. I do have one oil futures contract at $77 a barrel. That is down, to $73 a barrel right now. Today with oil, especially on those fears that China won't be reopening as thought. But I think there's real strong support for oil and those energy stocks that a lot of people are invested in, especially as oil comes down. If it comes down to around $70 a barrel, the U.S. has committed to buying oil and taking oil off the market to refill the Strategic Petroleum Reserve right around $67 to $72 a barrel. So what that is over the last... I gotta take a drink. Sorry. So over the last year, as Russia invaded Ukraine and just oil prices just spiked, we had at one point we had $120 barrel per oil. The U.S., the United States, started withdrawing oil from its petroleum reserve, right? An underground cave system of something like 700 million barrels of oil. The U.S. started taking oil out of that, selling it on the open market to the tune of 1 million barrels a day to bring down those oil prices. And that has worked. Oil prices have come down. But now that SPR, that petroleum reserve, is down to like 400 million barrels, which is the lowest it's been in about 40 years. 1982 or so was when it was down this low. So we are getting dangerously close to running out of oil in this strategic petroleum reserve, and it's got to be refilled. Well, the Biden administration, the government has come out and said, you know what, if oil gets down lower, then we will buy oil off of the market and restock this petroleum reserve. And they've committed to doing that right around $67 to $72 a barrel. So right now we're at $73 a barrel. So that's why I think there is very strong support for oil right around $70 a barrel at least. So if oil does come down a little bit more, I'll probably buy another futures contract. I think you can be very confident in buying some of those energy stocks that have gotten hit as oil prices came down a little bit. You can be very confident that those are going to do well. A lot of those oil companies, Chevron, Exxon, the ones we talked about here, Devon Energy, FANG, Diamondback Energy, ticker FANG. Those all have production costs of oil right around $30 to $40 a barrel, right? So even if oil comes down to $70 a barrel, then they are still cash flow machines. They're still very much profitable and are going to be spinning out those dividends, right? And of course, if we do get some kind of a commodity super cycle like Goldman Sachs is talking about, with oil back to $100, $110 a barrel into 2023, if China does reopen, a lot of this is that China story where China has tried for a COVID zero policy where they have just locked down, kept the country on lockdown for years, trying to fight COVID, whereas most of the rest of the world has moved on. The idea is that if China relaxes some of these COVID policies, these lockdown policies in its country, then that could be huge growth for China, for the world next year, and could really lift a lot of these commodity prices. So if we do get anything like that, then we are going to get much higher oil prices, and you're going to see just a bounce back in a lot of these energy stocks. So Gabrielle wants to know, do I like Conoco Phillips above all of them? Now, so a couple of weeks ago, we had our our energy stocks for the Bowtie Index, energy stock update for the Bowtie Index. A lot of you out there in the nation know I love, I hold shares of Chevron, Devon Energy, Diamondback Energy, which is ticker FANG. I hold shares of those. I hold shares of Conoco Phillips, but Conoco Phillips is the only one that made it into that Bowtie Index, right? Now, there's a reason for that. It's not necessarily that I like Conoco Phillips above all of them, that I would hold Conoco Phillips only and not the other ones. And that's because with that Bowtie Index, then some of the qualifications for that was it had to have 1 year, it had to have 3-year sales growth that was above the peer average. It had to have 1 year sales growth above its own 3-year average, right? So it had to be over the last 3 years, had to be growing faster than its peers, than the competition. That over the last year, it had to be growing faster than itself has been over the last 3 years. So gaining momentum on its peers. The profitability, the operating margin had to be above peers over that 3-year average, and then that 1 year profitability had to be above its own 3-year average. So while I like a lot of these other stocks, these Devon, Diamondback, Chevron, while I really do like those as far as cash flow, as far as performance and dividends, they didn't meet those qualifications for that. Only Conoco Phillips met those quantitative qualifications for the index. So I like Conoco Phillips for the reasons that we talked about in that video. Very much a Permian Basin driller, going to have about 50% of its sales over the next 10 years from the Permian Basin, which is a low-cost field to produce from. So a very good stock, but I wouldn't necessarily buy only that one company or prefer it above all these others. I still would hold shares of Chevron, maybe of Devon Energy, maybe even of Diamondback. Diamondback would probably be the 4th on the list, though. So yeah, Ambrose says, I remember picking up a few Devon at $6 a share. Why didn't I load up more? Yeah, that Devon Energy was just an amazing story. Up tenfold just over the last couple of years, and the dividends have just been huge. What else? So XXX69 Biz wants to find my hot girls here. I'm gonna hide that one. This isn't the place to have your spammy shit there. Noel Bossard wants to know, China good or bad? China is supposed to be the saving grace next year, right? As the rest of the world falls into recession, we are 100% getting a recession in the U.S. next year. Sorry, folks, that's just how it is. Earnings for U.S. companies are going to have to come down. They are still tragically high estimates. So U.S. corporate earnings are going to come down. That's going to hold stocks down. Europe is still seeing a recession, probably in a recession right now and into 2023. So China was going to be the saving grace, right? China was supposed to relax, as it said is going to start doing. It's supposed to relax those COVID lockdown measures. All year it has been stimulating the economy, lowering interest rates and reserve requirements for its banks. So as the rest of the world was increasing interest rates and making for stricter economic policy, China was doing the opposite, all right? And so we were expecting China to rebound next year to really lift global growth through that story. Now, with the unrest, with the protests, with the increase in COVID infections over this last week, COVID infections have hit an all-time high in China. So that is threatening that idea, that thesis that China is now going to be able to open up next year and really be able to grow its economy. I still think they get there, maybe just a little bit later than expected. So, I think that's the thing that could hold down stocks over this, December and January, as well as some of the other things we've been talking about on the channel. So, those high utility bills for U.S. consumers really going to put a crimp in consumer spending. Stocks are overvalued, right? And those estimates for corporate earnings for next year have to come down. So I think we're looking at a tough December or January for stocks. But then, as we get into January and even February, then I think the picture starts looking much better. As I said, I do think China ends up reopening just a little bit later into March and April. Obviously as the weather improves, temperature heats up, then people start getting out and those COVID infections start coming down naturally anyway. their vaccine deployment starts increasing, over the winter here. And so I think, China does pick up. Chinese stocks do well. I think that helps global growth and helps stocks around the world as well. We're just going to have to wait a little bit longer than we expected. What else? Russell wants to know about the commodities ETF, PDBC. Great ETF to get kind of an overarching kind of idea on this commodities play that we talked about. So yeah, those commodity ETFs. Obviously, you always want to look at the expense ratio on those ETFs. Some of those can get quite high. So you look at those. Anytime you want to look for an ETF in a space, what you can do, you can always just go to Google or type in your search bar, in your URL bar here, what you want. So we'll do commodities ETFs, commodities, if I can spell it right, ETF. Do the thing. So, growth stocks ETF, value stocks ETF, commodities ETF, as we have here. And then, scroll down until you find ETFDB. That's the website. It's a great website for finding lists of ETFs to find. So we'll just click on here, commodities ETFs. And what you're usually going to see the largest ones, these assets, so assets under management for each of these. So you're going to see the largest ones, those generally, but not always. Okay, so those largest ones generally have the lower expense ratios. They usually have better trading liquidity, so lower bid-ask spreads, things like that you want to look for. So we do see the PDBC, the Invesco Optimum Yield Diversified Commodity Strategy. No K1 ETF. That's a long name, but a good ETF. You got some of these. The DBC is also a good commodity one. You can go up here and you can look at returns. You can look at expenses. So kind of comparing those expenses. The PDBC does charge a 0.62% expense ratio, which for ETFs is quite high. For commodity ETFs, it's not too bad. You do have some pretty high ones. 0.87% for the DBC. So that is way too high there. The iShares S&P Commodity Index Trust, the GSG, 0.75%. So that's fairly high there. So you do want to look at these expense ratios. You can look at the dividends for each of these. Average dividend yield for the PDBC is showing only 0.01%. So I would want to look at that. These commodity ETFs don't generally pay quite the dividends that you'll find in in the individual stocks, the miners and things like that. So you might want to look at the miners as well as some of those ETFs. What else do we have? Mary Bianca wants to know about what are your thoughts on clean energy stocks? It's weird that the clean energy stocks, the alternative energy stocks, haven't done that well this year, even despite high energy prices. Generally, you get that relationship where if energy is extremely expensive, if oil is very high, then these alternative energy stocks do very well as also because of course investors are looking at demand destruction for the energy names, for their oil companies, things like that into the clean energy stocks. But with the sell-off in growth stocks this year, with that crash in any kind of stock with growth in the future, then the alternative energy stocks have sold off. So I would be looking at those. This is a lot of those are in good value territory. So I think you can start looking at some of those alternative energy stocks. What else? What are the risks associated with? Okay, Greg wants to know what are the risks associated with investing in JEPI, JEPQ. Do you recommend buying now? So a lot of these short or these covered call strategy funds are extremely popular. He's talking about the JEPI here, the JEPQ. I know the QYLD is also extremely popular. The problem with these is they just tend to lag. They lag their index by so much. We can look at the QYLD because that's really the most popular one here. That's the NASDAQ covered call ETF. And let's look at that, and I'll show you kind of what I mean. If you look at the QYLD, it's going to pay about a 10% dividend, which is a great dividend. It's what attracts a lot of people to this stock or to this ETF. And you see here, on the right, a lot of the related ones. So the RYLD is the Russell 2000 covered call. The JEPI here, he's talking about the Equity Premium Income ETF. We've got the XYLD, which is the S&P 500 covered call. The NUSI, NUSI, the NASDAQ 100 one. We've got a lot of those high yield ETFs there. But I want you to look at the chart here and look at this and think about what this means. Okay, so if we compare the QYLD, which is the NASDAQ covered call ETF. So this company, the Global X, they buy the NASDAQ 100 index, right? The 100 largest stocks in that NASDAQ index, a lot of tech stocks, right? And then they sell covered calls against them on a monthly basis to provide that cash flow, to provide that dividend that they put out on a monthly basis. And if you compare that to the NASDAQ itself, here over the last year, you'll see what I mean, or over the last 5 years even, just over the last 5 years. So this ETF has underperformed the NASDAQ over the last 5 years, up 63%, even after the sell-off. This ETF is down about 30%, right? So you've lost 30% over the last 5 years. Yes, you have gotten that about 10% annual dividend, but you've lost 30%. And if you would have just invested in the NASDAQ 100 ETF, so like the QQQ ETF, you would have made 63% on your money. So about a 90% difference in returns on these two stocks. And now I know those dividends are persuasive, are enticing, but you are just losing so much. Remember, you're getting taxed on those dividends every single year you collect them. Whether you reinvest them, whether you spend them, whatever you do with those dividends, you're still getting taxed on those. So that 10% yield is actually probably closer to a 7 or 8% yield because of those taxes. Those returns, you're not getting taxed on those until you sell the stock. Okay, so if you invested in the QQQ, that NASDAQ 100 stock, you wouldn't have to pay taxes until you sell that stock, right, for those capital gains taxes. So, I don't think investors really understand why, the risks in these covered call strategy ETFs and what's actually happening here. I know you say you're never going to sell them, so you don't worry about this lower price, but you will eventually sell those, and you're going to take a ginormous loss, on those shares. So I would just be worried about those. We have a couple of videos on the channel that I've done, monthly dividend stocks better than the QYLD, dividend stocks better than the QYLD, just individual companies, individual dividend stocks that have far outperformed the index, have far outperformed those covered call strategies in the QYLD and those other ETFs. So definitely check out those and look for those rather than maybe some of those ETFs. DL wants to know, is AT&T overpriced right now? Could the price drop significantly, or will it forever be propped up by the hedge funds? So a couple of questions there. Propped up by the hedge funds. Hedge funds, they're looking, especially, BlackRock, the ETFs, right, that cover the indexes. They are always going to invest in, some of them are market cap weighted. So they have to invest in the largest companies, the largest companies in each sector, each industry. As well as some of the most stable companies, right? And AT&T checks all those boxes. Okay, AT&T is, a historic telecom company that we are always going to need its services, whether it's broadband, whether it's wireless, a lot of those. It is a leader in wireless. So now that, a lot of you've heard me talk about AT&T in the past. I hated it over the last few years because they took on so much debt to buy up these other companies and become something they weren't, right? They bought up Dish Network. They bought up, Time Warner, tried to be in internet, tried to be in media, tried to be in all these other industries. And it's just not who AT&T is. Now that they've got this focus back on telecom, so they sold off all those assets, sold off Time Warner, spun that off to Warner Brothers Discovery here back in December. It is now just a telecom company, like it should have been. And I think that focus back on telecom is really where it needs to be, and is going to make the company, a strong investment, right? It's not going to make you rich. It's not going to blow the doors off, right? I'm holding shares since January. I think I'm up about 8 to 10% on the shares plus the dividend. Dividend is still very strong. Dividend is 5-6% yield, so very strong dividend. Share price that is still very attractive on a valuation basis. So it's not going to go down to that. Even if it goes down a little bit, then I still think you're still going to be safe on the downside on that. So yeah, I own shares of AT&T. I hold shares of AT&T, and I'm going to hold it for that dividend and for the price over the over the long term. Okay, what are your thoughts on REIT MPW? George wants to know what are my thoughts on the REIT MPW. So Medical Properties West, another REIT that I really like, a REIT that I own, right? And this, it's come down quite a bit. A lot of the real estate stocks have come down. I think real estate as a sector is probably the second or third hardest hit sector in the economy over this year because those interest rates have been going up so high. But so this stock is down something like 40, 50%. I still like it though. Dividend is still very strong. Not to say that they won't have to cut that a little bit. I think the market is betting on a dividend cut for MPW, betting that it can't keep up that kind of a dividend as earnings come down a little bit. What's really driving the stock down though is warnings of bankruptcy for some of the tenants. Now that isn't a bankruptcy for MPW. MPW is not going to file bankruptcy. MPW owns real estate for healthcare providers, right? They own real estate that hospitals are built on. They own real estate that clinics are built on, okay? And we're always going to need hospitals and clinics, okay? So MPW is not going to go under. What investors are worried about is that some of the larger tenants under that rent from MPW are going to go under, and that could hit short-term earnings, right? But healthcare is a great sector to be in, a great long-term demographic trend for the sector. I like the stock. I continue to hold the stock, and I'll continue to hold it, especially at this value. What else? So we need to invest in oils, wells, railroad strike, buying ideas. So Richard wants to know about the railroad strike and buying ideas on that. I would look at trucking companies. Obviously, if people can't transport their stuff by rail, then they're going to have to do it by truck. So I would look at the trucking companies. I would look at Amazon, things like that. So other transportation networks, maybe even air. So for air cargo rates, I'm sure are going up if a railroad strike happens, things like that. What else? Hard to make up 20 plus years of not investing. Aside from Odite, do you like Vale? So the Savvy Money Show asks if I do I like Vale? Not really. I do like, obviously from the commodity super cycle that we could be heading into, commodities could do very well. I like the miners. But Vale really worries me because it's a Brazilian company. Okay, anything Brazilian, they just reelected the socialist president, that was up on charges. It was heading towards a prison sentence at one point. They reelected him in that kind of on again, off again kind of socialist experiment they've got going on down there. So you're going to see much more pressure on the miners, on the Brazilian companies from the government as far as fees and taxes and things like that. Vale, I just think, Vale is a good company. I just think the political backdrop it's competing in right now is not good. And there's just other mining stocks that are much better and don't have that risk. Okay, so if you're looking at mining stocks, I know Vale has done very well over the past, maybe over the past year. The dividend is probably extremely high, but it's just not worth the risk. Okay, so if you're looking in mining, you've got other companies, you've got FCX, you've got BHP, you've got a lot of other companies, miners that are domiciled and work more in those developed nations, a little bit more stable nations, SCCO, Southern Copper, even the ones operating in Chile and Peru, right, are much better political environment than you're going to have in Brazil over the next couple of years. So I would be cautious about that. It's very important to understand the risks in these stocks rather than just going for the one with the highest past returns or the highest dividend yield. Often it's the highest yield because the stock prices come down, or so the highest returns because the stock price was so low because of some of those risks, and then it just jumped off of those. But those risks are still there, and it's something you need to watch out for. Ace wants to know, do you think inflation will come back higher with a vengeance? Higher, not necessarily. I do think we've seen the peak of inflation, hit 9% there in June, July. I think that was the peak. Obviously, it's come down to on the CPI index, it's come down to just under 8%. So it has come down, and the market's cheered that. I think it's going to be more persistent, though, than people expect. The Fed still expects inflation to come down to like 2.1%. And now that's on their measure, that's on their preferred measure, the CPE, which isn't the PCI. It's a little bit different measurement. So the PCE is down to about 5.1% last month, expected to come in Thursday at 5%. They're expecting that to more than halve, though, still to 2.1% the end of 2023 into 2024. And I just don't see it. I think with some of those bigger factors, you got to look at rent prices for inflation, because that's about 30% of the CPI and other inflation measures. With the increase in house prices over the last 2 years, and rent has just not kept up because landlords couldn't, they had that eviction moratorium, so they couldn't kick people out, so they weren't raising their rents. So rent has just not kept up with housing prices. Buying a house is now 1.5 times more expensive than renting it, because housing prices have come up so much and rent prices just have not kept up. Okay, it's something we covered a couple of weeks ago in our buy versus rent video. And that is usually right around 1.0, maybe 1.1 times more expensive than rent, but certainly not 1.5 times. Okay, so that gives you an idea of how much rent prices have to come up to really level out the market, to bring that back into balance, right? So we are going to continue to see higher rent prices over this next year. Obviously, rent isn't something that can go up overnight, because these are 1 year plus leases on residential or commercial properties, right? So that takes time to see those rent increases come through the economy. And so we have to see rent prices come up. We'll see it continue to come up through 2023, through 2024 as it catches up to those home prices. And that's going to keep inflation higher than expected. Okay. Now, I do think as we get into 2023, that year-over-year measure of inflation will come down a little bit, and the market is going to take that off and on with optimism, and then it's going to be then it's going to be disappointed because it's not coming down that fast or as fast as expected. So it's really something where you have to play off those bear market rallies, right? I don't think this is going to be a bull market that is just going to jump higher and continue to go higher. I think this is going to be a much more volatile bull market into 2023. Because you are going to get that optimism around those CPI numbers when inflation does look like it's coming down, but then you're going to get disappointment that it's not coming down fast enough, and because that means that the Fed can't start lowering rates to spur the economy. So rates are going to stay higher for longer than expected. That's going to hurt corporate profits, and that's going to hurt the stock market. That's kind of the big picture idea that you have to be looking at with inflation and with stocks. So I'm going to cut it off for today. We're just over an hour into the live stream. Thank you, everybody, for being here. Love having these Q&A sessions, just being able to talk back and forth with you. If I didn't get to your question, please ask it in the comments below, and I'll try to get to that later on today. But other than that, I will see you in the next video.